Before I start, I'd like to say a quick thank you to our sponsor, Fidelity International. You can find out more about them at fidelity.co.uk/money to the masses. Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's driving investment markets and what to look out for in the days and weeks ahead. Now, last week we drew to close the month of January. As the adage often goes, as goes January, so goes the year. So what people often do is look at how January or the stock markets performed in the month of January and project that for the rest of the year. There seems to be some evidence that that might actually be a good indicator for the rest of the year. But the bad omen, therefore, for stock market investors is that stock markets generally finish lower in January. So if you look at the S&P 500 and the Dow Jones, they closed down for the month. And a lot of that was driven by, obviously, at the early stages of the month, we had some of the Iran conflict that we had between the US. So that tension, the geopolitical tensions rose and then sort of dissipated. But it was really the coronavirus towards the latter part of the month which started to drive concerns for economic growth in China in particular and globally, which I covered in more detail last week. So what we had on the last day of the month, we had the US stock market fall almost 1.7% as those fears over the global economy and the impact on the US economy accelerated. So come Monday, when the Chinese stock market eventually opened, we were expecting the market to play catch up and fall fairly heavily. And in fact, it did fall about 7.9% in a single day, which was the biggest one-day fall we've had since 2015 in Chinese equities. But at the same time where things were being very gloomy, the dark clouds were gathering, defensive equity sectors started to outperform, bonds started to perform very well, gold started to perform very well as people rushed to haven assets. The Chinese authorities hit the panic buttons and they hit them hard. In fact, they actually injected more than 170 billion US dollars worth of liquidity into financial systems. That's a hell of a lot. They were trying to prop up the stock market and the Chinese economy. And since then, what we've seen is the Chinese authorities have actually agreed to cut the tariffs on some US imports to the value of $75 billion worth. Now, that again is a huge amount. And part of that is down to the fact that the Chinese economy is suffering because of the coronavirus. You've seen footage of businesses being closed. We've heard of people like Google or whether it's Starbucks closing operations out there, at least temporarily. Now, the impact is that the economy is likely, as I mentioned last week, to have a GDP figure that is lower than the typical 6% level. So in a position where your economy is weakened and under threat, then it means that in the trade war, you've got less bargaining power. And that's to the benefit of the US, especially in a year where Donald Trump is trying to get re-elected. So that is probably why the Chinese authorities have actually cut some of the tariffs or going to cut them in the coming days and weeks. And so is it a sign that things are far worse than they are letting on, particularly about the state or the size of the coronavirus and the impact it's having on the economy? But of course, when you get mass liquidity get pumped into any stock market, it starts to filter out elsewhere. And the euphoria of the cuts to the potential cuts to tariffs and the liquidity from the Chinese authorities, throwing that Trump was basically acquitted. You remember he had the trial in the US where the Senate were voting on whether he was going to be held for certain charges. Then he was effectively acquitted. That collapsed. That gave another boost to the US stock market. What we saw is the US stock market and even European stock markets rebound to all-time highs. And that's an incredible turnaround. We've almost seen a V-shaped rebound. If you looked at Japanese equities, for example, they collapsed one day and then rebounded more than 2.5% the next day. And in the falls that happened, they were crashing through some key support levels, which started to sort of throw up some technical analysis alarm bells, made them start to ring. And there were lots of people starting to think we were seeing a sizable change, a shift in sentiment, and maybe stock markets were about to collapse significantly. But the rebound we've seen this week has been quite incredible. It's back to those all-time highs. But are they sustainable? That's the question. When you get these whiplash moves, these sudden sort of to and fro's, the collapses and the rebounds, that can be a sign that there is a change in underneath. There's some sort of transition going on, particularly at tops of markets. So we'll have to wait and see. Is this a rebound? Are we going to continue higher? Is the bull market still in place? Will we keep pushing to new all-time highs, not just in US equities, but globally? We'll have to see. Of course, with Chinese equities and Asian equities bearing the brunt of the recent sell-off, we'll want to see a rebound in those sectors. So it'll be interesting to see what happens in the coming days and weeks, but a lot of it will centre around the headlines over the coronavirus and also GDP figures, not only that come out of China and other Asian communities or countries, but also out of the US and any impact, particularly in Europe. And when I say Europe, I mean Germany. Don't forget that Germany exports a lot to China. But of course, when we're looking at markets at all-time highs, we often then look at earnings. You will have heard earnings season mentioned in previous videos. There's been some more key earnings reports. Now, Alphabet, which is essentially Google for most people, they actually missed expectations, so they were disappointing. So that was alongside the likes of Facebook, which was a disappointing report and missed expectations as well. So that is not necessarily backing up the lofty valuations that we see, but we'll have to wait and see what happens in the coming quarters. But on the flip side, we've seen some crazy action in things like Tesla. Now, Tesla share price, go and look at it, finish this video, flick over and have a look. The share price of Tesla has almost doubled in a matter of weeks. It's gone up about 180%, which is crazy. It's almost parabolic. It is more resembles Bitcoin at its sort of peak than it does almost anything else. And so it will be interesting to see what happens to that in the coming days and weeks, and if that collapses and how that impacts sentiment. And of course, the other thing to bear in mind is currency. I've not mentioned currency for some time on these videos. The pound has started to weaken. We've broken down through that key $1.30 level. And the reason that's happened, we've now Brexited. We've left the European Union, but the reality is starting to set in that Boris Johnson is having to almost table the idea again that a hard Brexit is a possibility to be able to strengthen his side of bargaining of any trade deal negotiations that are going to happen between us and the European Union. So markets suddenly didn't like that and wobbled a little bit. And the currency, when I'm talking about market, I'm talking about the dollar pound exchange rate, and the pound weakened slightly. We're still just below that $1.30 level. It'll be interesting to see what happens in the weeks and months ahead, particularly as we head into the latter part of the year, because if it does look like we're going to crash out with a no-deal Brexit, as it were, then you could see the pound weaken. But equally, if negotiations go well, then you could see the pound strengthen. So that is it for this week on Damian's Midweek Markets. There's a lot to keep an eye on. Things are very sort of volatile at the moment. We've seen the VIX pick up, the fear index in markets. So there's a lot going on, a lot of moving parts. So keep an eye on it in the days and weeks ahead. You can contact me as ever. Damian at moneytothemasses.com is the email address. Twitter, moneytothemasses with the number 2. And of course, you can find us on Facebook and Instagram, and do subscribe to our YouTube channel.